As a business owner, it's common to want to know how much money you've earned on the money you invested in your business. And that's where the return on equity, or ROE, comes into play. For example, if you initially invested $40,000 to open your bakery, you might wonder how much that $40,000 has earned after a while. To determine your return on equity, divide your earnings before tax by your average owner's equity. Your average owner's equity can be found by taking the average of your owner's equity from the beginning and end of a period. The owner's equity is found on the balance sheet. For example, if your equity was $40,000 at the start of year 1 and $70,000 at the end, you'd simply add those two numbers to get a total of $110,000 and divide it by 2, the number of periods you're comparing, to get $55,000 in average owner's equity. Now that you know your denominator in the equation, let's look to the income statement once again to find out your numerator, which is your earnings before tax. Since you must divide your earnings before tax by your average owner's equity to determine your ROE, you'd take $7,000 divided by $55,000 to learn that your return on equity, or ROE, is now 13%, which means you've earned that much on the money that you left in your company. This helps you determine if you're making a worthwhile investment in your business by comparing it to other industries. For instance, if you know that you could generally earn 10% by investing in the stock market, your 13% looks like a good investment because you're earning more than 10%. Let's calculate ROE together.